Silver miners are about to report earnings, and the number that is going to come out of those earnings reports, the free cash flow per share, the margin per ounce, the revenue per ounce figures that will appear in black and white on income statements and balance sheets in the next 3 weeks, is a number that the equity market has not priced, a number that Wall Street consensus estimates do not reflect, a number that is going to force every institutional analyst who covers mining equities to immediately revise their price targets upward by a magnitude that has not been seen in the mining sector in over a decade. I want to tell you exactly what that number is before the earnings reports hit, because the investors who understand it before the reports are released are positioned to capture the repricing that happens in the days immediately following the releases. The investors who discover it from the earnings reports themselves are buying into a repricing that has already begun, and the investors who wait for the analyst upgrades that follow the reports are buying the second leg of a move that started 2 steps earlier. Here is what I mean specifically. Silver has averaged approximately $79.40 per ounce over the most recent quarter. The Wall Street consensus estimate for silver mining earnings for this quarter was built using a silver price assumption of approximately $68 to $72 per ounce, the range that prevailed when analysts last updated their models. Every revenue line, every margin calculation, every free cash flow projection in the consensus earnings estimate for every major silver producer is built on a silver price that is $7 to $11 below what silver actually averaged this quarter. That gap between the assumed price and the actual price is not a rounding error. For a senior silver producer with meaningful production volume, a $10 per ounce silver price beat against the consensus estimate translates into a free cash flow surprise that on a per-share basis is going to look like nothing the silver mining equity market has seen in recent memory. I am going to show you the math. I am going to show you which specific companies produce the largest earnings surprise. I am going to show you what the historical precedent says about how mining equity prices respond to earnings beats of this magnitude. And I am going to give you the exact positioning framework for the next 3 weeks while the earnings window is open. Let us go through every piece of it right now. Let me build the earnings math from the ground up, because every number I am about to show you is derivable from public information. Silver's actual average price this quarter, the consensus silver price assumptions embedded in analyst models, and the reported production costs of the senior silver producers. Nothing in this section requires any proprietary data. It requires the arithmetic that Wall Street has failed to perform. Silver averaged $79.40 per ounce in the most recent quarter. That is the actual average spot price across the full quarter based on daily closing data. It is not a peak price. It is not a single session high. It is the time-weighted average price that silver producers receive for their production across the entire quarter. The consensus earnings estimates for the major silver producers were last updated by Wall Street analysts at various points during the quarter. The majority of those estimate updates use silver price assumptions in the range of $68 to $72 per ounce, consistent with where silver was trading when the analysts last revised their models. Some analysts updated their models when silver crossed $70. A smaller number updated when silver crossed $75. Almost none of the consensus estimates reflect silver averaging $79.40 for the full quarter, because the consensus was set before silver reached and held those levels. The gap between the consensus silver price assumption and the actual average silver price this quarter is therefore approximately $7.40 to $11.40 per ounce. Call it $9 per ounce at the midpoint. Now let me show you what a $9 per ounce silver price beat does to the earnings of a typical senior silver producer. Take a producer with annual silver equivalent production of 15 million ounces, a mid to large senior producer by current market standards. That producer's quarterly silver equivalent production is approximately 3.75 million ounces. At the consensus silver price assumption of $70 per ounce, with all-in sustaining costs of $14 per ounce, the consensus free cash flow estimate for the quarter is 3.75 million ounces multiplied by $56 per ounce margin, which equals $210 million of quarterly free cash flow. At the actual average silver price of $79.40, with the same $14 per ounce all-in sustaining cost, the actual free cash flow for the quarter is 3.75 million ounces multiplied by $65.40 per ounce margin, which equals $245.25 million. The actual quarterly free cash flow is $245.25 million against a consensus estimate of $210 million. That is a $35.25 million earnings beat, a 16.8% beat against consensus on the free cash flow line. Now translate that to earnings per share for a company with 200 million shares outstanding, a typical share count for a senior producer of this size. The earnings beat of $35.25 million divided by 200 million shares equals $0.176 per share earnings beat. If the consensus earnings per share estimate for the quarter was $1.05, consistent with the $210 million free cash flow at this share count, the actual earnings per share will come in at approximately $1.226, a 16.8% beat on a per-share basis. In the mining equity sector, a 16.8% earnings beat against consensus is not a modest outperformance. It is a significant surprise. Equity markets typically price mining sector earnings beats of 10 to 15% magnitude, with immediate price responses of 12 to 20% in the trading sessions immediately following the earnings release. A 16.8% beat, delivered simultaneously by every major silver producer in the sector because they are all operating with the same price realization tailwind, has the potential to produce a sector-wide re-rating of significant magnitude in a compressed time frame. And this is for a mid to large producer at a $9 midpoint silver price beat. The larger and higher margin producers in the sector will show proportionally more dramatic beats because their higher production volumes amplify the per ounce price beat into larger absolute dollar surprises. Let me now walk through the specific earnings dynamics for the major categories of silver producers, because the surprise magnitude varies across different company types in ways that create specific positioning opportunities. The pure play senior silver producers are the category with the most dramatic earnings surprise potential. These are companies whose revenue is predominantly silver, companies where silver price is the dominant driver of earnings rather than a secondary byproduct alongside a larger gold or base metal operation. For pure play senior silver producers, the $9 per ounce midpoint silver price beat flows directly to the bottom line with minimal offset from other commodity price movements. Their earnings leverage to silver price is essentially 1-for-1. Every dollar of silver price surprise is a dollar of additional margin per ounce produced. A pure play senior producer with 20 million quarterly ounces of silver production, one of the largest in the sector, receives the $9 per ounce price beat on every ounce it produces. That is $180 million of additional quarterly free cash flow above consensus expectations on this one variable alone. For a company with 300 million shares outstanding, that translates to a 60 cents per share earnings beat on the free cash flow line. If the consensus estimate was $1.40 per share for the quarter, the actual result will come in near $2 per share, a 42.9% beat against consensus. A 42.9% earnings beat in a sector where 10 to 15% beats produce 12 to 20% immediate price responses has the potential to produce an extraordinary equity price move in the days following the release. The silver streaming and royalty companies are the second category with significant earnings surprise potential, though the mechanics are different from the primary producers. Streaming companies receive physical silver at fixed low costs, typically $3 to $6 per ounce, in exchange for upfront capital provided to mining companies. Their margin per ounce is therefore the difference between the silver market price and their fixed $3 to $6 streaming cost. At $79.40 average silver this quarter, versus a $70 consensus assumption, a streaming company with fixed costs of $4 per ounce sees its per ounce margin expand from $66 at the consensus price to $75.40 at the actual price, a 14.2% margin expansion. Streaming companies typically trade at premium multiples because of their low-cost, low-risk business model. Premium multiple times 14.2% margin expansion produces a significant earnings beat in absolute dollar terms, even on modest streaming volumes. The silver royalty companies, which receive a percentage of revenue from mines in which they hold royalty interests, see an even more direct translation of silver price beats into earnings because their revenue scales linearly with realized silver price. A 2% net smelter return royalty on a mine producing 5 million ounces per quarter generates 100,000 ounces of royalty silver equivalent. At $79.40 versus the $70 consensus, that royalty stream generates $7.94 million versus $7 million, a 13.4% revenue beat from price alone, with essentially zero additional cost because royalty income has no associated production cost. The silver-gold intermediate producers, companies with meaningful silver production alongside substantial gold production, present a more complex earnings picture because the silver price beat is partially offset or amplified by gold price behavior in the same quarter. Gold averaged approximately $4,750 in the most recent quarter, above most analyst gold price assumptions for the period, which were set in the $4,400 to $4,600 range when models were last updated. These companies therefore benefit from both a silver price beat and a gold price beat simultaneously. Their earnings surprise is the sum of both metals' price beats against consensus, weighted by their respective production split. For companies with a 60% silver, 40% gold production mix, the combined price beat effect produces earnings surprises in the 18 to 22% range, larger than the pure silver producers in some cases because of the dual metal tailwind. Let me now give you the historical precedent for how silver and gold mining equities have responded to earnings beats of the magnitude I just described, because the historical record is the most reliable guide to the near-term equity price response you should expect in the weeks following the earnings releases. The most directly relevant historical episode is the Q3 2020 earnings season for silver miners. Silver averaged approximately $24 per ounce in Q3 2020, against analyst consensus assumptions that had been set when silver was trading around $17 to $18 earlier in the year. The silver price beat against consensus for Q3 2020 was approximately $6 to $7 per ounce, somewhat smaller than the $9 midpoint beat in the current quarter, but comparable in structure. The earnings reports that emerged from Q3 2020 showed free cash flow beats in the 20 to 35% range across the major silver producers. The equity market response was immediate and dramatic. In the two-week window following the Q3 2020 earnings releases, the major silver producers saw equity price increases of 18 to 34%. The streaming and royalty companies, which reported the cleanest and most directly translatable silver price beats, saw equity price increases of 22 to 28% in the same window. The sector-wide re-rating from the Q3 2020 earnings surprise was one of the sharpest two-week moves in the silver mining equity sector in the modern era. The Q2 2016 earnings season provides a second relevant precedent. Silver averaged approximately $17.60 in Q2 2016, against consensus assumptions set in the $15.50 to $16 range earlier in the year. Silver price beat against consensus, approximately $2 per ounce, smaller than the current quarter but structurally similar. The resulting earnings beats produced equity price responses of 12 to 22% in the 2 weeks following the earnings releases for the major silver producers. A third precedent is the Q1 2011 earnings season. Silver averaged approximately $34.50 in Q1 2011, against consensus assumptions set around $28 when models were last updated before the quarter began. The $6.50 per ounce silver price beat produced earnings surprises of 20 to 40% across the sector. The equity price responses in the 2 weeks following earnings releases ranged from 15 to 45% for senior producers, with the streaming companies that had recently listed showing even larger responses due to their low-cost margin leverage. 3 historical precedents. Comparable silver price beats against consensus. 2-week equity price responses of 12 to 45% across the sector following earnings releases. The current quarter's $9 midpoint silver price beat against consensus is the largest of the 3 comparable episodes in absolute per ounce terms. The earnings surprise magnitude, 16.8% for a typical senior producer, 42.9% for the largest pure play producers, is at the high end of the historical range. The historical precedent suggests the 2-week equity price response following the current quarter's earnings releases could be the largest sector-wide mining equity re-rating in at least a decade. The timing of the earnings releases makes the positioning window specific and measurable. The major silver producers typically report quarterly earnings on a schedule that concentrates most of the sector's results into a 2 to 3 week window. The first major silver producer reports in approximately 10 days. The last major producer in the current cycle reports approximately 22 days after the first. The 2 to 3 week window in which the earnings surprise will be revealed across the sector is the period in which the historical re-rating move has always been most concentrated. Positioning established before the first earnings release captures the full re-rating move. Positioning established after the first releases captures the re-rating move from the remaining unreported producers, but misses the initial spike from the first reports. Let me bring gold into the earnings analysis because the gold market is providing the broader cycle context that determines whether the earnings-driven re-rating is a standalone quarterly event or the beginning of a sustained multi-quarter re-rating of the entire precious metals mining sector. Gold is currently at $4,826. The gold mining sector, specifically the senior gold producers, is also entering an earnings season with a comparable structure to silver. Gold averaged approximately $4,750 in the most recent quarter, against analyst consensus assumptions set in the $4,400 to $4,600 range when models were last updated. The gold mining sector is therefore simultaneously entering earnings season with a gold price beat against consensus of approximately $150 to $350 per ounce. The combined earnings surprise from both gold and silver producers reporting above consensus earnings in the same earnings season is a precious metals mining sector-wide event, not a silver-only or gold-only story. When the entire precious metals mining sector simultaneously reports above consensus earnings driven by metal price beats, the institutional response is not simply to reprice the current quarter's earnings. Institutional analysts upgrade their full-year and forward-year earnings estimates simultaneously, reflecting the higher realized metal prices as a signal that their prior price assumptions were too conservative. The upgrade cycle, current quarter beat, triggers full-year estimate upgrade, full-year upgrade triggers forward-year estimate upgrade, forward-year upgrade triggers price target upgrade, is a compounding repricing mechanism that extends the equity price response beyond the immediate 2-week window following earnings. The gold-silver ratio at 59.7 to 1 and compressing is the additional confirmation that both metals are simultaneously in their strongest fundamental position relative to equity market pricing. When both metals are beating consensus price assumptions simultaneously and the ratio between them is compressing, meaning both are strong and silver is gaining ground on gold, the combined effect on mining equity sector valuations is multiplicative rather than additive. The sector-wide re-rating that follows simultaneous beats from both metal sectors is historically the largest category of precious metals equity repricing event. The macro environment supporting the metal price beats, monetary system stress driving institutional allocation, physical demand from industrial and sovereign sources, supply constraints limiting mine output growth, is not a single quarter phenomenon. It is the same structural environment that has been building throughout this cycle and that both metals prices are reflecting in their sustained new high behavior. The earnings surprise in the current quarter is not a one-time windfall from a temporary silver and gold spike. It is the first quarter in which the structural price environment, silver above $75, gold above $4,500, has been sustained long enough to produce a full quarter earnings impact rather than a partial quarter effect. The implication is significant for positioning. The current quarter's earnings surprise establishes a new baseline for analyst models. When analysts revise their silver price assumptions from $68 to $72, up to $76 to $80 for forward quarters, which they will do in response to the earnings beats, every forward-year earnings estimate in the sector revises upward simultaneously. The equity price targets that follow from those revised estimates represent a sector-wide repricing that begins with the earnings releases and continues through the analyst upgrade cycle in the weeks and months that follow. Let me give you the exact positioning framework for the earnings window that opens in 10 days and closes in approximately 22 days, because the specific timing creates specific entry and management decisions that are different from the long-duration physical silver positioning framework I normally discuss. The earnings window positioning framework has 3 phases corresponding to the 3 stages of the earnings event. Phase 1 is the pre-earnings positioning phase, the 10 days between now and the first major earnings release. This is the phase in which informed investors establish positions before the surprise is revealed. The equity market has not yet priced the earnings surprise because the surprise has not yet been reported. Silver and gold mining equities are trading at valuations based on the consensus estimates that underprice the metal price realization by $9 per ounce of silver and $150 to $350 per ounce of gold. The gap between current equity valuations and the valuations that will prevail after consensus estimates are revised upward is the return available to investors who position in Phase 1. For Phase 1 positioning, the specific vehicles to consider are the senior silver producers with the highest production volumes and lowest all-in sustaining costs. The companies where the $9 per ounce silver price beat has the largest absolute dollar impact on free cash flow and the largest percentage impact on earnings per share relative to consensus. The pure-play senior producers are the highest priority because their earnings leverage to silver is the most direct. The streaming and royalty companies are the second priority because their low-cost margin structure maximizes the percentage earnings beat from the silver price surprise. Phase 2 is the earnings release phase, the 2 to 3 week window in which the sector reports. This is the phase of maximum price action. Historical precedent shows the largest single-day moves in mining equities occurring in the trading session immediately following an earnings release that beats consensus by 15% or more. The pure-play senior producer with a 42.9% earnings beat will produce a reaction in the session following its release that is the most dramatic single-day opportunity in the earnings window. Investors who have established Phase 1 positions hold through this phase and capture the full re-rating move. New investors entering during Phase 2 can still capture the re-rating moves from producers that have not yet reported. The sequence of releases means there are multiple reaction events across the 2 to 3 week window. Phase 3 is the analyst upgrade cycle, the 2 to 4 week period following the end of earnings season in which institutional analysts revise their forward estimates and price targets in response to the beats they observed. This phase is less dramatic on a single-day basis than Phase 2, but can produce sustained equity price appreciation as the upgraded price targets attract institutional capital that was waiting for analyst validation before committing. Quality senior producers that receive the largest earnings beats in Phase 2 and the largest estimate upgrades from analysts in Phase 3 have historically produced the best total returns across all three phases combined. For investors who hold physical silver rather than mining equities, the earnings window is less directly relevant to your positioning because physical silver prices do not respond to earnings reports in the same way equities do. However, the earnings surprise and the subsequent analyst upgrade cycle are catalysts that increase the visibility of the silver bull case to institutional investors who cover the mining sector. As mining equity valuations reprice upward in response to the earnings beats and analyst upgrades, the media and analyst coverage of the silver story intensifies. That intensified coverage is a catalyst for additional investment demand for physical silver from investors who were not previously engaged with the silver thesis. The earnings window, therefore, has an indirect positive effect on physical silver demand through the increased visibility it creates for the silver price story. For gold holders, the gold mining sector's simultaneous earnings beats create the same analyst upgrade cycle for gold mining equities that the silver beats create for silver producers. Hold existing gold positions through the earnings window and add quality senior gold producer exposure if you want to capture the gold mining equity re-rating that occurs alongside the silver mining re-rating. The precious metals mining sector re-rating from simultaneous gold and silver earnings beats is a more powerful institutional catalyst than either metals sector re-rating alone. The complete summary of everything that matters from today. Silver averaged $79.40 per ounce in the most recent quarter. Wall Street consensus earnings estimates for silver miners were built on silver price assumptions of $68 to $72 per ounce, a $7 to $11 per ounce underestimate of the actual realized price. A typical senior silver producer with 15 million quarterly ounces will report a 16.8% free cash flow beat against consensus. The largest pure-play senior producer with 20 million quarterly ounces will report a 42.9% earnings beat. Every streaming and royalty company in the sector will report margin expansion of 14 to 16%, driven by the silver price beat alone. Historical precedent for earnings beats of comparable magnitude. Q3 2020 produced 2-week equity price responses of 18 to 34% across senior producers. Q2 2016 produced 12 to 22% responses. Q1 2011 produced 15 to 45% responses. The current quarter's $9 midpoint silver price beat is the largest in absolute per ounce terms of the three comparable episodes. Gold simultaneously beating consensus by $150 to $350 per ounce creates a precious metals mining sector-wide re-rating event. Both metal sectors surprising simultaneously is historically the largest category of mining equity repricing. The earnings window opens in 10 days. It closes in 22. The consensus was set on wrong silver price assumptions. The actual results will reveal the gap. The equity market will reprice. Investors who are positioned before the first release capture the full move. Subscribe to this channel right now. The earnings season for silver miners is the single most important near-term catalyst for precious metals equity investors, and this channel will cover every major release with the depth and precision the mainstream financial press does not deliver. Share this video with every silver mining equity investor you know. 10 days is not much time. Comment below and tell me, which silver mining company are you most focused on for the earnings season, and what price response are you expecting? I read every single comment.